12 countries now pair a dedicated retirement visa with either a pensioner tax regime or a territorial tax system that exempts foreign pension income. Italy, Greece, San Marino, Malta, Panama, Costa Rica, Nicaragua, Belize, Ecuador, Cyprus, Mauritius, and Thailand. Every finance YouTuber has made the tax-free retirement abroad video. None of them ranked all 12 against each other using 2026 rules. Greece's 7% flat tax sounds like a gift, until you read the July lump sum payment deadline. Malta's tax-free marketing hides a 15% flat rate with a €7,500 annual minimum. Italy's 7% deal only works if you move to a town under 30,000 people in the south. And Uruguay just launched Tax Holiday 2.0 in January 2026, an 11-year exemption on foreign capital income that almost nobody is covering yet. The average American retiree pays federal tax on Social Security, state tax in 38 states, and still owes the IRS no matter where they live. Finding a country where your pension is genuinely protected from local taxation isn't a luxury. It's the difference between $1,900 a month that stretches and $1,900 that doesn't. FBAR reporting kicks in at $10,000 in aggregate foreign accounts. FATCA requires Form 8938 disclosure at higher thresholds. No country on this list makes the IRS disappear. But the right local tax regime can keep an extra $200 to $500 in your pocket every month. And over a 20-year retirement, that's $48,000 to $120,000 you either keep or donate to a foreign treasury because you trusted a headline. We ranked all 12 countries by how real the tax break actually is versus how it's marketed. Income caps, expiration dates, geographic restrictions, payment deadlines, and what you still owe the IRS regardless. Counting down 12 to 1. Stay until number 1 because the country that most delivers on the tax-free promise isn't the one with the best Instagram sunset, and the gap between marketing and reality on number 12 will save you from a tax bill you never saw coming. Every tax claim in this video was verified in July 2026 against official government sources. Greek Independent Authority for Public Revenue Pensioner Regime Documentation, Italian Agenzia delle Entrate 7% Flat Tax Guidelines, Malta Tax Authority Retirement Program Rules, Panama's Territorial Tax Codification in Cabinet Decree 170, Costa Rica's Territorial Income System under the Income Tax Law, Belize's Qualified Retirement Program Statute, Cyprus Non-Domicile Rules per KPMG's April 2026 Residency Guide, Mauritius National Budget 2026 Pension Exemptions, Thailand Revenue Department Remittance Rules, and PwC Tax Summaries for San Marino and Uruguay's Tax Holiday 2.0 effective January 2026. We also note, no country on this list eliminates your U.S. federal filing obligation. FATCA and FBAR reporting apply regardless. This ranking measures local tax treatment, not IRS obligations. We modeled each regime against a standard retiree profile. $2,000 to $4,000 monthly in U.S. pension and Social Security income, no local employment, planning a 15 to 20-year retirement horizon. Thailand tops this list at number 12, meaning the gap between tax-free retirement marketing and 2026 legal reality is the widest of any country here. Thailand's retirement visa is accessible at 50 or older with 800,000 baht in a Thai bank or 65,000 baht monthly income. The LTR Wealthy Pensioner category offers tax exemption on remitted foreign income, but requires $80,000 in annual passive income or $40,000 with $250,000 in Thai property investment. Here's the exposé. Thailand's 2024 tax reform shifted toward taxing foreign source income remitted into Thailand after 180 days of tax residency. A proposed 2-year exemption window for new remittances was introduced in mid-2025, but the legal framework remains contested and interpretation dependent. Most retirees on the standard OA visa are not on the LTR track. They're navigating a remittance-based system where bringing your U.S. pension into a Thai bank account may trigger local taxation depending on timing, amount, and how the Revenue Department enforces the new rules. The catch compounds. Thai banks now restrict account opening for tourist visa holders, making the visa itself harder to obtain. Banking and tax regulation moved in the same tightening direction within 18 months. A furnished one-bedroom in Chiang Mai's Old City runs $350 to $500 monthly. Bumrungrad Hospital in Bangkok charges roughly $80 for a specialist consultation versus $300 or more in the US. The cost of living advantage is real. The tax-free marketing is not. U.S. citizens in Thailand must still file Form 1040. If your Thai bank accounts aggregate $10,000 or more at any point in the year, FBAR filing is mandatory. Thailand's tax ambiguity doesn't reduce your IRS obligations, it adds a second layer of compliance risk. The verdict? Thailand offers world-class healthcare and cost of living, but tax-free pension is the most overstated claim in the retirement space. Budget for professional Thai tax counsel or remove it from your tax-free shortlist. But if you want a European-sounding rate that still isn't zero, number 11 markets exemption while delivering a bill. Malta's Malta retirement program gets marketed as a tax-advantaged European base. The reality. It's a 15% flat tax on foreign pension income remitted to Malta, with a minimum annual tax of €7,500 regardless of income level. Your foreign pension must constitute at least 75% of your chargeable income. You cannot be a Maltese national. You must purchase or rent qualifying property, purchase minimum €275,000 in certain areas, or €220,000 in Gozo and the South. That's not tax-free. That's a capped rate with a floor that guarantees Malta collects €7,500 from you every year, even if your pension is modest. For a retiree on $2,500 monthly, that minimum tax represents a significant effective rate hike on the lower portion of income. Separately, Malta's general pension income exemption for residents over 61 was substantially increased for basis year 2026, exempting pension income up to €37,104. But the MRP track and the domestic exemption track are different programs with different eligibility rules, and conflating them is how expats end up in the wrong regime. A furnished one-bedroom in Sliema or St. Julian's runs $1,000 to $1,400 monthly. Malta is not a budget destination. Total monthly costs for a comfortable retirement run $2,500 to $3,500. Malta's healthcare system is excellent, and English is an official language. The MRP requires a one-time €2,500 government fee plus €500 per dependent. Processing takes 4 to 6 months through a licensed agent. The catch? Malta is expensive. English is widely spoken. Healthcare is solid, but the Mediterranean lifestyle premium is real. Budget $2,500 to $3,500 monthly minimum. The verdict? Malta offers a predictable 15% rate, not tax freedom. Rank it accordingly. If you want an Indian Ocean island that sounds tax-free but caps the benefit, number 10 is the same pattern at a smaller scale. Mauritius requires retirees to be 50 or older with a minimum monthly income of $1,500 or savings of $24,000 for the retirement permit. The tax story sounds generous. The 2026 budget raised the foreign pension income exemption threshold from approximately €3,420 to €5,000, meaning the first €5,000 of foreign pension income is exempt from Mauritian tax. Above that threshold, foreign pension income transferred to Mauritius is taxed at a flat 15%. On a $3,000 monthly pension, roughly $2,200 per month is taxable at 15%. That's $3,960 per year to the Mauritian Revenue Authority. Marketing calls this tax-free retirement. The math calls it partial exemption with a hard cliff. A furnished apartment in Flick and Flack or Grand Bay runs $600 to $1,000 monthly. Total monthly budget, $1,800 to $2,500. Mauritius has no capital gains tax and no inheritance tax. Genuine advantages for wealthier retirees. But the pension exemption cap means this program serves high-income retirees better than Social Security-only households. The catch: Mauritius is remote. Flights to the US are expensive and long. The lifestyle is extraordinary, multicultural, safe, beautiful. But you're building a life on an island 11,000 miles from American family. Healthcare is good in Port Louis, limited elsewhere. The verdict: Mauritius delivers a genuine partial exemption, not the zero tax promise the retirement blogs imply. If geographic lock-in is your constraint, number 9 restricts you to specific Italian villages most Americans have never heard of. Italy's 7% flat tax regime for foreign pensioners is real and genuinely attractive if you qualify. You must not have been an Italian tax resident in 5 of the prior 6 years. Your income must be predominantly foreign source pension income as defined under Article 49 of the TUIR. The tax applies for up to 9 years, not 15, not permanent. Here's the catch that buries the marketing. You must relocate to a municipality in southern Italy, Abruzzo, Apulia, Basilicata, Calabria, Campania, Molise, Sardinia, or Sicily, with a population under 30,000 residents. As of April 7, 2026, the population ceiling was raised from 20,000 to 30,000, opening additional towns. But you still cannot use this regime in Rome, Florence, Tuscany hill towns, or the Italian lakes. The tax deal is tied to depopulating the South. The 7% applies to all foreign source income during the regime period, which is broader than pension alone. But Italian bureaucracy, language requirements, and the 9-year sunset mean this is a structured program, not open-ended tax freedom. A furnished apartment in a qualifying Calabrian comune runs $400 to $600 monthly. Total monthly budget in southern Italy, $1,500 to $2,000. Extraordinary value inside the Eurozone if you accept the location constraint. Healthcare through Italy's SSN after residency registration provides comprehensive coverage. Copays are minimal. Private specialist visits run $80 to $150 without insurance. The FIP equivalent passive income visa isn't Italy's primary route. Retirees typically enter on an elective residence visa requiring approximately €31,000 annually in passive income, higher than Portugal's D7. The catch: healthcare through the SSN requires residency registration. Property in popular southern towns is rising as the program gains attention, and you still file U.S. taxes. The verdict? Italy's 7% is one of Europe's best real deals, if you'll actually live in a small southern comune for 9 years. Number 8 is smaller, quieter, and comes with a rate that's low but not zero. San Marino offers an atypical residence program for pensioners with a substitute tax on pension income at approximately 6%. Not zero, but among the lowest flat rates in Europe. The microstate sits entirely within Italy, uses the euro, and maintains independent tax sovereignty. The exposé? San Marino is Europe's fifth smallest country with a population under 34,000. The residency process is bureaucratic, the housing stock is limited, and the program is genuinely niche. Designed for high net worth Europeans, more than typical American Social Security retirees. Banking, healthcare, and daily services require Italian cross-border access for most specialist needs. The 6% rate is honest and low. But the practical barriers, housing scarcity, limited international flights, microstate bureaucracy, mean the tax benefit only matters if you were already considering San Marino for lifestyle reasons. The catch: American citizens face limited consular support. The nearest U.S. embassy services run through Florence, Italian is essential, and 6% is not 0%. San Marino's cost of living mirrors wealthy northern Italy, budget $2,000 to $2,800 monthly. The atypical residence permit requires proof of stable pension income and health insurance. Processing is slow by microstate standards, 6 to 9 months. For the typical American Social Security retiree, San Marino's 6% rate on a $24,000 annual pension means $1,440 per year in local tax. That's honest, low, and predictable, but it's not the 0% promise that territorial systems deliver. The verdict: San Marino delivers a real low flat rate in a surreal setting, but it's not a mass market retirement solution. If your tax break expires when your non-dom status ages out, number 7 has a countdown clock built in. Cyprus has aggressively marketed its non-domicile regime to retirees and investors. Non-doms are exempt from the special defense contribution on dividends and interest for 17 years. The 60-day rule allows tax residency with as few as 60 days physically present if you don't spend more than 183 days in any other single country and maintain economic ties to Cyprus. The exposé for pensioners: Cyprus taxes employment and pension income under normal progressive rates for residents. The non-dom benefit primarily shields investment income, dividends, interest, rental income from abroad, not your Social Security check. As of January 2026, rental income treatment under non-dom rules was further modified. Pension income transferred to Cyprus is taxable at standard rates reaching 35% at the top bracket. The catch: Cyprus has rebuilt its reputation after the 2013 banking crisis, but financial due diligence on banks remains prudent. The North/South division still complicates property title in some areas. And EU residency through Cyprus doesn't mean Schengen access for all purposes. A furnished apartment in Limassol runs $800 to $1,200 monthly. Paphos is slightly cheaper. Total monthly budget $2,000 to $2,800. Cyprus's retirement visa requires proof of approximately €2,000 monthly in pension income from abroad. The non-dom application is separate from the immigration process. You need both a residency permit and a tax residency election. Professional guidance costs $3,000 to $5,000 for the combined setup. The verdict: Cyprus is a powerful non-dom play for investors, But retirees living on pension income alone don't get the benefit the Instagram ads promise. Before the second half, tax residency is the most complex decision you'll make as a retiree abroad, and getting it wrong costs tens of thousands. ISA Compass specializes in cross-border tax and residency planning for Americans relocating overseas, particularly the U.S. Greece, U.S. Italy, and U.S. Central America corridors this video covers. Link in the description. If you're torn between Greece's 7% lump sum regime and Panama's Territorial 0, that's not a Google search question. That's a professional calculation. Back to the ranking. Number 6 has a famous 7% rate with a payment deadline that will end your regime if you miss it. Greece's 7% flat tax on foreign source income for retirees is the most discussed European tax incentive in 2026, and it mostly delivers transfer tax residency to Greece, elect the regime, and you pay 7% on all foreign-sourced income, including pensions, dividends, and rental income for up to 15 years. You must not have been a Greek tax resident in 5 of the prior 6 years. Here's what the marketing buries. The special tax must be paid as a lump sum by the last business day of July each year. It cannot be offset against any other tax liabilities. Greece abolished the March 31st application deadline in 2026. You can apply year-round now, but the July payment deadline is absolute. Miss it, and you forfeit the regime for that fiscal year. The FIP visa requires 3,500 euros monthly passive income, a high bar. But the tax regime itself is among the most verified and documented in Europe. International Living ranked Greece number 1 globally in 2026 for good reason. On a $48,000 annual pension, the 7% lump sum is $3,360 per year versus $7,200 or more under standard Greek progressive rates. Over 15 years, that's a savings of $50,000 or more in local tax alone, depending on your bracket. A retiree in Crete on the 7% regime keeps roughly $600 more per month in pocket than a retiree on standard Greek rates. That margin compounds into a fundamentally different retirement quality: better healthcare access, travel budget, emergency reserves. The catch: Greek bureaucracy, language outside expat zones, property taxes, and ENFIA assessments. The 7% is Greek tax only, U.S. filing continues, and 15 years is a ceiling, not permanence. The verdict: Greece's 7% is the real deal with real deadlines. Rank it high for retirees who clear the income bar and respect the calendar. Number 5 is often confused with its neighbor, and the confusion costs money. Ecuador's pensioner visa requires $1,446 monthly in 2026. The tax treatment is where the story gets nuanced. Ecuador generally does not impose additional income tax on foreign source income that has already been taxed abroad, creating a practical territorial effect for U.S. retirees whose pensions are taxed at the federal level in the United States. The exposé: This isn't a codified zero tax forever statute like Belize's QRP. It's a practical outcome of Ecuador's tax code interacting with the U.S. Ecuador Tax Treaty and the reality of worldwide U.S. taxation. Ecuador taxes Ecuador source income at progressive rates. Your foreign pension, in practice, often faces no additional Ecuadorian liability, but often and statutory guarantee are different things. The catch, the $1,446 visa threshold moves with the basic salary. Cuenca is no longer undiscovered. Rents have risen. Bureaucracy in immigration offices requires patience and a local attorney. On a $24,000 annual Social Security check, Ecuador's practical territorial treatment means your pension faces no additional local tax, saving you potentially $1,000 to $3,000 annually compared to U.S. state tax states. That's real money, even if it's not codified as dramatically as Belize's QRP statute. The verdict. Ecuador delivers genuine tax efficiency for typical retirees, but it's a practical outcome, not a marketed program with a brochure. Number 4 had temporary incentives with an expiration date most blogs ignore. Costa Rica's Pensionado visa requires $1,000 in monthly lifetime pension income, same threshold as Panama. Costa Rica operates a territorial tax system. Only income derived from Costa Rican sources is taxable. Foreign pensions, Social Security, and IRA withdrawals from U.S. sources are exempt from Costa Rican income tax. Current legislation also provides temporary tax and customs incentives for Pensionado holders, valid through June 2026, including import duty exemptions on household goods and vehicle import benefits. After that date, the temporary incentive package requires monitoring for renewal or expiration. The expose, the territorial system itself is durable. It's codified in law, not a promotional program. But the import incentives and customs benefits that sweeten the deal have a shelf date. Retirees arriving after mid-2026 may face a different customs calculus. The catch? CAGA public healthcare enrollment is mandatory and based on declared income, typically $100 to $200 monthly for retirees. San Jose traffic is brutal. The Central Valley is humid. And $1,000 visa threshold doesn't mean $1,000 cost of living. Budget $1,800 to $2,200 monthly, realistically. On a $36,000 annual pension, Costa Rica's territorial system saves you from any local income tax entirely, a structurally durable benefit that doesn't depend on program renewal or application windows. The verdict. Costa Rica's territorial tax system is structurally sound, one of the most reliable in Latin America, with bonus incentives that may have an expiration date. Number 3 puts the exemption in statute, not interpretation. Belize's qualified retirement program is the clearest statutory tax exemption in the Americas. QRP status grants permanent exemption from all Belizean taxes on income received from sources outside Belize: income tax, capital gains tax, estate tax, and most import duties. You must be 45 or older, demonstrate $2,000 monthly in guaranteed income or $24,000 annually, and pass a background check. No interpretation required, no remittance timing games, no already taxed abroad arguments. The exemption is written into the QRP statute. Foreign pension income is not taxed in Belize, full stop. The catch? Belize is small, 400,000 people. Healthcare is adequate in Belize City and limited on the Cayes. Hurricane exposure is real. The $2,000 monthly income requirement is double Panama's threshold. And English is the official language, which is genuinely advantageous for American retirees. On a $36,000 annual pension, Belize's statutory QRP exemption saves every dollar of local tax, 0%, written in law, no sunset clause, no geographic restriction. The verdict. Belize delivers the most legally transparent tax exemption in Central America, if you clear the $2,000 income bar and accept the country's scale. Number 2 is the gold standard everyone copies but nobody beats. Panama's territorial tax system is the foundation every other Latin American program is measured against. Only income derived from Panamanian sources is subject to Panamanian tax. Foreign source pension income, whether remitted to Panama or held offshore, is not taxed. This isn't a time-limited incentive or a special application. It's constitutional tax architecture. Combined with the Pensionado visa at $1,000 monthly lifetime pension income and permanent residency from approval, Panama offers the most complete package: low visa threshold, permanent status, statutory retiree discounts, and durable territorial taxation with no expiration date and no geographic restriction. The expose at number 2 rather than 1, Panama's system is near perfect on paper, but the practical requirement of a licensed immigration attorney, Spanish language needs outside expat zones, and uneven public health care outside the capital mean the tax promise is only half the equation. On a $36,000 annual pension, Panama's territorial system means $0 in local income tax every year permanently with no application renewal. Compare that to Greece's 7%, $2,520 annually, or Italy's 7% in a restricted zone. Panama's zero is structurally simpler. The catch: U.S. citizens still file worldwide. Panama's discounts require maintaining your Pensionado carnet, and Boquete's popularity has pushed rents upward. $500 to $800 for a one-bedroom now, not $300. The verdict: Panama is the benchmark for territorial tax retirement, durable, codified, and paired with the most accessible visa on this list. Nicaragua is the country nobody puts at number 1, and that's exactly why it belongs here. The Pensionado residency program accepts applicants from age 45 with as little as $600 to $1,000 in monthly foreign pension income, depending on the immigration category, among the lowest thresholds in the world. Nicaragua operates a territorial tax system. Foreign source income is not subject to Nicaraguan income tax. Your U.S. Social Security, your pension, your IRA distributions, if the source is outside Nicaragua, the Nicaraguan tax authority doesn't touch it. No expiration date, no lump sum July deadline, no geographic restriction to southern villages, no 7,500 euros minimum tax floor, no remittance timing ambiguity. This is the expose. The retirement industry promotes Greece's 7% as a gift while ignoring that 7% is still 7%. It promotes Malta's 15% as a deal while ignoring the 7,500 euros floor. It promotes Thailand as tax-free while remittance rules tighten. Nicaragua offers actual 0% on foreign pension income under a territorial system, paired with the lowest visa income requirement of any country on this list. The catch is honest, and it's not tax, it's context. Nicaragua's political environment requires due diligence and geographic awareness. Grenada and San Juan del Sur have established expat communities. Managua is a different calculus. Healthcare is adequate in major cities, limited in rural areas. Infrastructure is developing, not developed. Banking can be cumbersome. And the U.S. State Department Travel Advisory demands you read it carefully and make your own risk assessment. A furnished colonial home in Grenada runs $400 to $700 monthly. Total monthly budget, $1,000 to $1,500. The lowest on this entire list for a genuine cultural retirement, not bare survival. On a $24,000 annual Social Security check, Nicaragua's territorial system means zero local tax and a visa threshold you clear with $14,400 in annual margin. No other country on this list offers that combination of accessibility and tax delivery in 2026. The catch on the U.S. side: you still file federal taxes. FBAR if your foreign accounts exceed $10,000 aggregate. FATCA reporting to the IRS. Nicaragua's 0% local rate doesn't touch your IRS obligation. The verdict? Nicaragua is number one because it most delivers on the promise the other 11 countries market. Zero local tax on foreign pension income, the lowest visa threshold, no expiration clock, no geographic lock-in, and the gap between marketing and reality is the smallest on this entire list. One more note on a program almost nobody is covering. Uruguay's Tax Holiday 2.0, effective January 2026, offers new tax residents an 11-year exemption on foreign source capital income. It's not on this list of 12 because Uruguay lacks a dedicated pensioner visa category, but if your retirement income is primarily investment-based rather than pension-based, it may outperform everything we rank today. The threshold for eligibility and the scope of exempt income types require individualized analysis. Consult a qualified tax advisor before assuming any particular benefit applies to your situation. And if you need that advisor, ISA Compass helps Americans navigate exactly these cross-border tax decisions. Which regime fits your income type, your timeline, and your risk tolerance? They specialize in the intersection of U.S. filing obligations and foreign tax residency elections, the exact overlap this entire video covers. Link below. Before you elect Greece's 7% regime or commit to a Nicaraguan territorial structure, a 1-hour consultation costs less than 1 year of filing in the wrong jurisdiction. 12 countries. One question: does the tax break survive contact with reality? Thailand. Remittance rules kill the promise. Malta. 15% with a €7,500 floor. Mauritius. Partial exemption, not zero. Italy. 7% but only in southern villages under 30,000 people. San Marino. 6% in a microstate. Cyprus. Non-dom doesn't cover pensions. Greece. Real 7% with a July deadline. Ecuador. Practical but not statutory. Costa Rica. Territorial, but import perks expiring. Belize, statutory clarity at $2,000 income. Panama, the territorial gold standard. Nicaragua, 0%, lowest threshold, smallest gap between promise and delivery. We rank these 12 on a single axis. When a retiree with $24,000 to $48,000 in annual pension income runs the real numbers with a qualified advisor, which country leaves the most money in their pocket after local taxes, accounting for caps, deadlines, geographic restrictions, and expiration dates? The answer isn't the country with the best marketing. It's the country where the statute matches the sales pitch. Every tax-free headline hides an expiration date, an income cap, or a geographic lock-in. Your job is to rank the deal, not the marketing. And remember, no country on this list eliminates your IRS obligation. Local tax freedom and U.S. filing responsibility coexist whether you like it or not. Getting the tax right is step 2. Step 1 is getting the visa. And most publications are still using dead numbers for that too. If you missed it, our visa expose video is the companion to this one. The tax-free promise means nothing if the regime expires before you finish unpacking. And if Uruguay's Tax Holiday 2.0 applies to your situation, investment-heavy rather than pension-heavy, it may outperform everything we rank today. Verify with a qualified tax advisor. The countries that win are the ones where the statute, the visa, and the monthly budget all survive contact with your actual bank statement.